Two moms, two marketers, two women new to the financial industry. They have a lot of questions. That's why they're bringing in financial experts to educate all of us here on A Penny or Two for Your Thoughts.
It's Chantel and Liz, and this is A Penny or Two for Your Thoughts. Here we go.
Oh my God, did that really happen? Let's do this. Yeah, that's happened. Hi.
Did I just intro us?
Yeah, you did.
What?
You did. Wow. We started in like this is going. We're going. We're gonna let this go.
We are. We're not even going to tell our guest how this rolls. We're not even going to give him any
This is
insight.
kind
Are
of
we just
exciting.
going to?
He has no idea what to
Is
expect.
this like a hazing? Are we hazing?
Just wing it. I'll just wing it.
Oh yeah. See, and he just. already
I'll
He's
joined
just
in.
curious.
I'm
He
just
started
kind of a
talking.
roll with it kind of guy. So
We're going to make our listeners guess as to whose voice that is.
Ooh. Yes,
Yeah.
listeners.
Ooh.
Mate.
How many years has our guest been in the industry that he's been in? Can you pinpoint that number?
Are you asking me?
Yeah. Why not?
Well, here's the thing. When I heard this person was joining our organization, Centris Federal Credit Union, I already met someone with the same name. And I'm like, oh my God, he's starting? No, it's not him at all. I'm like, oh.
Same name.
But
First and
you're
last?
just as cool. Just as
really,
cool. Yeah.
first and last name.
First and last.
I did not know there was another one
Oh,
of
yeah.
me in the Omaha metro area.
He's in Atlanta.
Oh, well, that
So, yeah.
explains it.
Yeah, yeah.
Okay.
So
there could be another one in the world somewhere. Sure.
Right.
Yes.
For sure.
Okay, that makes more sense.
yeah.
Freaky story about that. Okay, so my name is Elizabeth Garber. Like that's what I was born with.
Mhm.
Okay.
My husband works, he's an engineer at HDR, and he was emailing with somebody, I think at the city. I'm probably totally going to butcher this. But he was emailing with somebody, and her name is Elizabeth Garber.
Well, shout out, Elizabeth.
Right? Freaky. And it happened when we were dating. So like we were dating, and he was like, he got an email from this Beth Garber,
Right.
and it shows up as Elizabeth Garber, but she
Yeah.
signed up, her signature was Beth Garber.
Okay.
I was like, that's weird.
That is
because
a weird coincidence.
Garber is not a common last name.
No.
Yeah.
Gerber is a brand. Close.
True.
But Garber is not.
I feel,
Yeah.
Cam, I'm going to look at you right now because I feel like we're supposed to be recording and I think this is good. Like, we're good. Yeah. Are you good? Are you comfortable with
Yeah, I
us
think we're
going
good.
on? Are we good?
Yeah, that's fun.
Do you like that intro?
That was
Like we
great.
just kind of wung
We just-
it?
Yeah.
I mean,
wung
we
it.
like
Is that a
came
word?
in hot and then
Came
just
in real hot.
I mean, this plane was going 5,000 miles an hour and it didn't have the landing gear on.
You said almost another word, I think.
Did I?
I don't know.
No, maybe. It's part of my vocabulary.
Oh, God. Okay. Can we?
Okay.
What is today? Okay.
Today is the
know-
day after Valentine's Day.
Yes, that's where I'm going with this. You got that.
Okay.
Valentine's. How do you feel about this holiday? That holiday that was yesterday.
Okay. So here's the thing. Valentine's Day is actually my mom's birthday.
Okay.
So I never really celebrated Valentine's Day because it was always her birthday and I
gotcha.
wanted her to feel special. However, thanks to this holiday, it jacks up the prices on everything that as a
Right.
kid I wanted to get her.
Right.
Flowers.
True.
No.
Yeah.
Chocolates. No.
Yeah.
Go out to eat. Are you kidding me? I don't
Right.
want to
Yeah.
elbow the person that's
Right.
across from me because they
Right.
put the table so close together.
Yeah.
We had a really hard time even trying to get reservations when I was growing up just to take her out to eat. So
Yeah.
yeah, I've always had kind of a bitter taste to the holiday just because of that perspective. But then as I got older and
Yeah.
I don't know.
I don't-
I love love, but
I know. I love love. I don't know really
I
where
love
I
my
was
husband
going
every day. So why do I have to have a day to where I like go above and beyond?
I know. We went to school conferences.
Oh,
Hmm.
that's lovely.
Yeah. Let me tell you something.
how'd that go?
I'm gonna shout out to Jace on this show because the long story, he didn't go with us to conferences. And today he may or may not be grounded just because we need to work on some things in life as a 16-year-old.
Yeah.
Just got a text that he did get his haircut and it is a mullet.
It's
Mhm.
confirmed that this
Yeah.
is a mullet.
hmm
Okay.
I love Valentine's and school conferences that lead to a mullet.
So, I got payback. Payback's
Oh.
fun. Amazon. Look for a mullet wig. You put the mullet on and
Oh.
drop him off to school
Yes.
with your mullet wig
yes.
and him with his mullet, actual mullet.
Sweet baby. I'm coming in with you to school. Mom
loves you.
Sweet baby.
Have a sweet day, my sweet baby boy.
My little schnookums. Oh, Jace,
Yeah.
I'm coming for you. You think you can win this?
I just lost brownie points with Jace for giving you that idea.
It's good stuff.
Yeah.
All right, listeners, as we've taken you down a tunnel that's very, very deep and weird, we're gonna
Awkward.
we're gonna jump right in. I have no idea how this is gonna
For
go.
our listeners that don't know, our guest today has been in mortgage lending for 32 years and made Centris his home during the work week a little over a year ago. See what I did there?
Oh wow,
Yeah.
this is good.
Please welcome to the show the Assistant Vice President Mortgage Production, Brian Beard.
Woo,
Hel-
woo.
Hello, everybody.
Hello, hello.
Brian Beard of Omaha,
Of Omaha,
Nebraska,
not of
Atlanta.
Georgia.
Yes,
Yes.
yes.
Let's just get
We
that
just need to
on
make
the
sure.
record right
Yeah.
now.
Yes.
Yeah.
Born and raised in Nebraska.
Nice.
So, yeah.
Oh, so we have a Cornhusker. That's good.
Yes, you
We've been
do.
having a lot of Iowas. Hawkeyes
right.
in here.
A lot.
That's even where I went to school. So, yes, 100%
Wow.
Cornhusker. Yeah.
All right.
Sorry, Jace fans who are listening.
Yeah, it's all right. It's all right. You know,
It happens.
It does. It does. So we're going to jump right in. We met with you a couple weeks ago. We were talking about some different marketing pieces that we were going to be working on, and you had mentioned some different terms, and we're like, gosh, this could be a really good podcast just to kind of level set all the different terms that are out there when you're talking about mortgages and home buying and all the things,
Mhm.
right?
Mm-hmm.
So we're gonna ask some questions about what are the differences between things, why do people get confused? I know from my personal experience, and I know we've talked about this on the podcast before, it seems so overwhelming when you
Mhm.
buy a house for the first time or the second time or the third time. What does that look like, and all the different things that you need to know? And maybe it's not so bad if you know who to talk to and you're talking to the right people and,
Right.
and you're doing your pre-work. So we're gonna jump in. Are you ready?
Absolutely. Let's
All
do
right.
it.
Buckle up. Here we go.
All right.
Okay,
All right.
Brian, we're just going to start out kind of with the basics. Do you or can you help our listeners understand the difference between escrow and equity?
Yes. So, other than starting with the letter E, they are two completely different things. So escrow is basically a fancy way, at least in Nebraska, it's used differently in different parts of the country, but here in Nebraska and Iowa, escrow is a holding account where we put a homeowner's taxes and insurance if it is part of their payment, and which is that way most of the time. So a homeowner makes their payment to Centris. We take the taxes and insurance out of the payment and put it into an escrow account, which is just a holding account. And then we use that money to make sure that the taxes and insurance get paid on time during the appropriate times of the year. Typically, homeowners, it's once a year, and taxes, at least in Nebraska, it's twice a year.
Yep.
But that's what an escrow account is. And so then the homeowner doesn't have to worry about paying those
See, that's
on
so
their
nice.
own because it's part of the mortgage, and then we just take care of it behind the scenes.
Mhm.
And then that way we know they're paid and paid on time so they don't go delinquent as well, which is the
Right.
advantage to Centris.
Right.
So equity is the difference between the value of your house and what you owe on it. So as a quick example, if my value is $500,000 and my mortgage is $200,000, I have $300,000 of equity. And that's, you're always gaining that as you make your payment each month. A certain chunk of the payment goes to the principal balance, which reduces it. And also with appreciation, which I think we'll get into here in a little bit, as the house goes up in value and you pay the loan balance down, you're gaining that difference, which is called the equity. So
They both start with E's,
They do.
Yeah.
They
but
both
they
start
do.
with these.
You can get very confused very fast.
Oh, quickly. Yep.
That's where I'm at all day today. So here we are.
Right.
Okay, Brian. So just talking about equity, how can an average homeowner uses equity in their home to consolidate debt?
Sure. Yeah. So again, that equity is essentially not a non-liquid asset, right? So you have money in checking or savings, which is liquid, or the equity in your home is basically in a non-liquid form. But you can use that in the right situation to possibly consolidate a whole bunch of debt and use that equity in the house mainly to cheapen up your payments. So what we see some folks doing, particularly now as interest rates have risen over the past couple of years on all debt, is as auto loan interest rates have gone up, particularly credit card interest rates have gone up. And really, we call it a cash out refinance is what it is. It's really a payment conversation, not a rate conversation. That's where a lot of people get confused. They kind of get wrapped up in the rates, and it's really not a rate discussion. It's a payment discussion. So, as an example, what you want to kind of do is compare the separate payments that you have now. So, I have my first mortgage payment. Maybe I have a home equity loan. I have a car loan, and I have 4 or 5 credit cards. So, you add all those separate payments up and compare that to if I bundled it all into one new mortgage, what would that payment be? And then you see if it makes sense to do that cash out refinance and bundle it all together or not, essentially.
Right.
If the average person can save, let's just say $300 to pick a number, you're like, okay, that probably makes sense because there are going to be some closing costs on the mortgage to do the loan. But if you're say there's $2,400 in closing costs, but if you're saving $300 a month, that's an 8-month recoup time. So that's pretty quick. Anything less than a year is kind of ideal. And then what you want to, if your mortgage loan originator is doing their job the right way, which the Centris ones will, they will ask you, okay, what do you want to do with this $300 savings that we're gonna get for you? And that's where they're going to ask you questions, or should ask you questions about, do you have kids? Do you want to start a college savings fund? Do you think you have enough going towards retirement? Maybe we need to put this into an IRA. Do you just need to save it in a rainy day fund in case, if you're a homeowner, maybe the furnace quits on you and you need money for the furnace or whatever. So you can kind of work to figure out what's the financial goal of the homeowner to say, okay, we just kind of quote unquote found this $300. Let's make sure we put it to good use.
Right.
Yeah.
And you've taken everything and you've made it a little bit simpler on you as well.
Yeah, sure. And for budgeting purposes, you got one payment instead of like 7 or 8.
Right.
Yeah. You just have to make that one payment a month, and it's all taken care of.
Yep.
Great.
So I know you mentioned we were kind of talking about rates, and that kind of flagged me on some terms that we use tied to rates. So can you help us understand the difference between what a fixed rate is versus that adjustable rate mortgage? And a lot of times we see it in advertising or out in the industry as ARM. Can you help kind of explain that to us and how what the difference is between those?
Yeah, sure. The names are pretty straightforward. Fixed rate means just exactly that. The rate will not change over the life of the loan. So once you take out the loan at that rate, that's what it is for that 30-year time period or 15-year time period, whatever it is. An adjustable rate mortgage, or ARM, most of the time now, there is not, years and years ago, it was an adjustable rate right out of the gate. Well, over the years, that has kind of morphed into more of a hybrid, I guess is a good word to use, where it's fixed for a certain period of time at the beginning of the loan, and then it becomes an adjustable rate after that point. 2 of the most common ones these days are what we call a 7/6 ARM or a 10/6 ARM. And that first number means it's fixed for 7 years or fixed for 10 years. And then starting year number 8 or 11, it starts to adjust. The 6 in that equation there is how often the rate will adjust when it starts to adjust. So again, old school years ago, it used to be a 1-year adjustable. That was based on the index that we used a long time ago. That index is no longer around. The index that we use today is a 6-month adjustable. So it's going to adjust twice a year. So whether you should get a fixed rate or one that has the adjustable feature really boils down to how long do you see yourself keeping that loan? If you think you're going to be in the house long term and keep the loan long term, a fixed rate's probably better off. And that's what we're all kind of conditioned to want normally.
Yep.
But in certain circumstances, it might make sense. In the rate environment we're in now, there used to be a bigger difference between a fixed rate and then one that was, let's say, a 7/6, right? So that 7/6 rate was cheaper for the fixed portion because it wasn't fixed as long. The way the markets have been recently, there's a little bit of a difference there, but not much. And so we don't nearly find it advantageous to put people into the ARM loans now compared to like 4, 5, 6 years ago. simply because the market has changed. And so those rates have changed a little bit. So,
Right.
but that's the difference.
Okay. Who would be that demographic for that adjustable rate mortgage then? Is it somebody that maybe is often moving frequently for a job?
And there's even one where it's only fixed for 5 years, and that's probably the better one, where you, again, if it made sense, where that initial 5-year rate was, and let's just make a number up and say the 30-year fixed rate right now is 7, but you could get a 5/6 ARM at 6.25. So you're like, okay, 7 versus 6.25. I'll take the 6.25 for that 5-year fixed time period, knowing that maybe in year 6, when it starts to adjust, my job tends to move me every 5 years. And so I'll probably be selling the house, and I won't be in that loan in year 6 to have to worry about if it's going to adjust up or down. And by the way, the adjusting piece may or may not be a good or a bad thing. I mean, going into 2020, or even 2019, if you were adjusting in 2017 or 18, your rate actually went down for you without having to refinance or anything. So there was an advantage to having an ARM going into 2020 and 2021. Now, of course, as that rates have gone the other way, then if you have an ARM, it's going to go the other way as well.
Right.
So there's that give and take to it.
Yeah.
Right.
Yeah.
I like how you said just a little bit earlier that if you find a mortgage loan originator that really walks you through this, because what you just said, there's a lot happening there,
a ton.
and
Yes.
I, if I'm a first time home buyer, or if I am just new to this and I am going to be moving, or, things like that, are that very consultative approach that you want to find with somebody who's doing that. And I think that's kind of where all these questions today are, how do you find that right person? How do you know, what to even ask? And I think that's where we were starting to, get to some of these points today, is that's the basis, right? To start with.
Yeah. I mean, a good loan originator, and we have good ones at Centris, will always ask you questions, kind of like going back to that debt consolidation situation for a moment, right? They'll ask you questions about, besides just, obviously, let's use a purchase situation. Well, I want to buy this house. Okay, but how does this mortgage fit into your bigger financial picture?
Right.
There's 2 people that everybody should have in their life from a financial standpoint, besides for just base banking purposes. There's a financial advisor to help you manage your assets, and then there's a mortgage loan originator to help you manage your liabilities or your debts. And you should talk to each one of them once a year, to be honest with you, because as your life changes, your finances need to change with your life. And a lot of times I don't think people understand that.
Right.
And so they don't check in with their advisor on their investment side, and they don't check in with their mortgage loan originator on the liability side. And so I think they lose money sometimes because they don't adjust those 2 situations as their life changes.
Right.
Yeah.
Okay, so you have that person in your life, those people in your life, actually. So talk us through, when you're starting this process of looking for a home, what is the difference between pre-qualification and pre-approval? We hear both of those, and are they interchangeable? Are they the same?
They're similar.
Okay.
They're actually it's a similar process, but there is a subtle difference between the 2. Okay. And it's important to understand that, because even in the mortgage industry, a lot of people will use them interchangeably, but they're really not the same thing. So a pre-qualification is if you submit an application, the lender takes that application, runs that through an automated underwriting system that we use. And then based on the results of that automated underwriting system, we'll give you a letter that says you're conditionally approved, subject to basically verifying everything that you put on the application, right? It's quick, it's simple, but it's only as good as the information input on the application. Nothing is really verified. A full pre-approval goes the next step, and we do the steps that I just described. But in addition to that, we're going to collect some documentation. So pay stubs to verify your income, bank statements to verify your assets, of course, the credit. And then we're going to actually give that to an underwriter to say, hey, based on this what if sales price loan amount scenario, does everything look like it fits the guidelines that we have to follow for this loan scenario? And so they'll review it and say, yeah, based on what I've seen, the income fits the guidelines, the assets fit the guidelines, the credit fits the guidelines. So in a perfect scenario, the only thing left to do then is do an appraisal, because obviously you don't have a house at that point,
Mhm.
because it's a what if scenario, and a few other things. But at least you get those steps out of the way. And the biggest advantage to a full pre-approval is you as the buyer and your agent, when you do find the right house and you make an offer on that house, you've been kind of pre-vetted out by the lender, so that the seller knows and their agent knows, okay, these people are serious and the loan should go through. So we're not going to get 2 or 3 weeks down the road and all of a sudden go, oh yeah, you don't qualify, sorry. And then they've got to start all over, put the house back on the market, find a new buyer again, and they've just lost 3 weeks. So yeah, that's the difference.
And houses are moving too quickly, right?
Yeah, absolutely. Especially, we're sitting here in February, so the spring buying season coming up. If it's anything similar to the last 2 or 3, yeah, I mean, if you know anybody that tried to buy a house in the last 2 or 3 years, especially in the spring, early summer, it's been crazy with houses getting multiple offers. I mean, like 20, 30 offers at a time sometimes, and bidding wars and some crazy stuff. And so, yeah, that person who walks in bare minimum with a full pre-approval has got a little bit of a leg up over the other ones that don't.
Absolutely.
Right.
Yep.
Right. That underwriter, they really have kind of that upper hand on whether they get approved or not. So what all are they looking at when they are reviewing those pre-approvals? What types of things are they really trying to hone in on?
Yeah. So an underwriter basically is there to, again, validate what information they've been given and make sure it meets what I'm going to call the agency guidelines. So on a conventional loan, we either sell the loan to Fannie Mae or Freddie Mac. And so we follow their guidelines. It's not necessarily Centris guidelines. It's the Fannie Mae or Freddie Mac guidelines. So they've got some guidelines as to, credit score, for example. They've got a minimum credit score. So if your credit score falls below their minimum, you're not even eligible for the loan to go through them. And then as far as income, they look at something called a debt to income ratio. So, and we're talking gross monthly income compared to your monthly debts. And so they want that total debts, including the new proposed house payment, to be no more than typically 45% of your gross monthly income. So they're making sure that the income calculation is correct, the debt payments all look correct. As far as the assets, obviously, if you're going to put, to pull a number, let's say you're going to put 100,000 down. Okay, then we got to know where that 100,000 is coming from. It has to be from a verifiable source, like a bank statement or an asset statement or something like that. It can't just be cash into the mattress at home, because we can't verify where that came from, right? They've got some regulations, make sure that you didn't obtain it illegally or things like that. So the underwriters are looking at all of that, and then when we get the appraisal on the house, then they're reviewing that appraisal too, that it meets Fannie's guidelines on that as well. So they are kind of the last one to say yay or nay on the loan. The buck stops with them as far as being the decision maker on the loan. Yeah.
Very good. A lot going on.
I know.
Behind the scenes, right?
Those underwriters, they're doing a lot.
They are.
I always see them at the office too, like head down.
They are.
Well,
they are.
yeah. I mean, they have a challenging job,
Yes,
because
they do.
they're
making some tough decisions.
tons of guidelines that they have to make sure that loan meets. I mean, the Fannie Seller Guide is over 1,000 pages long.
Jeez.
Wow.
So, I mean, there's a lot to it. And so, yeah, those people really have, a tedious job to make sure that all the pieces of the puzzle fit.
Right.
That's the way I kind of describe it.
Right.
So you've been pre-approved, ready to kind of go into this next step. What are the different types of mortgages that people should be looking at?
Sure.
Or could be looking at,
Yeah.
based on their space in life, I guess?
Right. Yeah. So there's 3 main types, and then there's some subsets that I'll describe second. So the 3 main types, and I already kind of touched on it, is there's a conventional loan, an FHA loan, and a VA loan. Those are kind of the old school, traditional big 3 types of programs. Mm-hmm. The VA one, you have to have served in certain capacities in the military to qualify for. So if you've never been in the military, you don't qualify for a VA loan, which makes sense.
Right.
So then we're quickly down to 2, conventional and FHA. The old school way of looking at FHA, it was kind of more geared towards a first-time buyer, because it required less down payment, was a little bit looser on some of those underwriting guidelines that I just talked about. But over the years, Fannie Mae and Freddie Mac kind of came up with a few of their own products that are similar to FHA. And then in addition to those, there are some what I would call niche products where there's some specifically you have to be a first-time buyer, for example, to qualify. Or there's some specifically geared towards more for low to moderate income folks. And so there's a maximum annual income. You have to be under that number to qualify for that. So there are those types of loans too. But those are kind of the subtle differences between the main ones. And again, which one is right for you really just depends on the loan officer looking at your application and analyzing your financial situation to see, again, all those factors that I mentioned, the FICO score and the assets and everything, which program looks like. And a good loan officer will give you choices. They should give you choices. If you talk to a lender somewhere and they're just like, yep, here you go. Here's your product. That's the first warning sign. And again, they should listen to your situation and go, here's option 1, here's option 2, and maybe there's an even option 3 for you.
Yeah.
It's your choice. It's your financial situation. You decide which way you want to go. Here's the pros and cons to all 3 of them.
Mm-hmm.
I don't care which one you go with. You decide.
Right.
It's your life.
Right. Absolutely.
Yeah. Yep.
Very good.
So I know when I was buying a home way back when, long time ago, actually, I've heard the term, and maybe not necessarily in my situation, but I've heard the term before, like discount points.
Mm-hmm.
How would you describe that to somebody who's maybe going into buying the home for the first time, or just going in and buying a home and they've never even heard that term before?
Yeah, sure. Discount points allow you to buy the interest rate lower. In a nutshell, you can pay money to buy the interest rate down. Okay. So there's a quick and simple way to kind of calculate that, obviously, is okay, if I'm going to spend this money, what does that do to, here's the principal and interest payment at a rate with no points. Then here's the principal and interest at a rate with, say, 1 point. And 1 point is 1% of your loan amount. That's how you calculate it. So borrowing $100,000, 1 point is $1,000 for a quick example. So then you have to do the math of, okay, if I'm going to spend $1,000 to take my principal and interest payment from here to here, how much is that difference? And divide it into that $1,000 to say, again, how quickly am I going to recoup that point?
Right.
On average, it takes about 5 years to recoup a point. So there again, going back to,
Right.
Do I see myself, A, being in the house for 5 years, B, having the loan for 5 years? Because if the answer to either one of those is no, then don't pay the point, because you're wasting part of that money. You pay $1,000 and you only keep the house or keep that loan for 2 years. Well, you wasted 3 years of those points essentially.
Right.
So is there an advantage to paying points? Yes, there could be, but you got to understand the recoup time in order for it to make sense or not.
Right. And that's really where that mortgage loan originator is going to help you understand, is that the right,
yes, absolutely.
right avenue to go down?
So if you're working with somebody and they're quoting you a rate with 2 or 3 discount points, or I hate to say this, but maybe they don't even mention them in the conversation, and then you get what's called the loan estimate, which is kind of the breakdown in writing of everything, and you see discount points on there, yeah, that's a red flag. You need to ask about that and say, why, is there a way maybe that I can't, don't have to pay these?
Right.
Because if you, again, do that quick math calculation and it's going to take you, 8 years to recoup those points, that's a long time.
Right.
There's a lot you have to look at. I mean, and there's a lot of, to your point, a lot of scenarios that you can look at, and just to kind of sift through. Another one being locking your interest rate.
Mm-hmm.
What does that look like? What if you're looking at the entire situation here?
Yeah. So when you start the process, the loan originator is going to ask you if you want to lock your interest rate or float your interest rate. You have the choice. It's up to you. And the two terms mean just exactly that. So if we lock the interest rate, it cannot change. So let's say a purchase example, it takes around 30 days start to finish from the time you apply to the closing date. So if you lock in on day 1, that's your interest rate, no matter what interest rates do over that 30-day time period.
Up or down?
Yeah, up or down, either way. So you lock it, let's just pick a number and say 7%. And 2 weeks in, they go to 6.5%. You're going to go, dang, shouldn't have locked. But on the reverse side, they go to 8%. You're going to go, sweet, I locked in at 7%.
Yeah.
I made a great choice. there is no loan originator that can predict what interest rates are going to do. Again,
Right.
I've been doing this for 32 years. My crystal ball is just as cloudy as anybody else's in this industry. If anybody tells you they can predict what interest rates are going to do,
Run
no.
for the hills.
Run.
No, they can't. That's like predicting what the stock market's going to do,
Mhm.
right? And it's the exact same thing, because our rates are based on what the mortgage-backed securities or bonds. So as the bond market changes from one day to the next, just like the stock market does, our interest rates do that accordingly, and kind of throughout the day, to be honest with you, as markets fluctuate. So what it really boils down to there again is ask your loan originator, okay, here's my payment at 7%. What's my payment at 6.875, which is 6 7/8? How much does it change for every eighth? Because normally we go in 1/8% increments for interest rates most of the time. So for every eighth that the rate changes, let's say my payment changes by $22. So I, as the home buyer, have to make the decision, okay, do I want to, roll the dice that maybe if they go down that eighth, oh, great, my payment's $22 cheaper. Or if they go up an eighth, well, my payment's going to be $22 higher. And over that 30-day time period, is it really worth it or not? Is the $22 really worth it? Either way, and then that's the decision I make. So there again, it's, asking the loan originator, well, what are they going to do next week? They can't tell you,
Right.
Right. But it's just a comfort thing, or the term I used to use when I was originating. It just depends on how much of a gambler you are.
Yeah. Right.
So if you want to roll the dice and hope that they go down an eighth or a quarter and you save $22 or $44, great.
Yeah.
Roll the dice, see what happens. But if you're like, not worth it, all right, then let's just lock it in and be done with it. Yeah.
Very good.
I just feel like I got a whole lot smarter in a matter of
Right?
Now I want to go home and look at all my mortgage
I know,
documentation and be like, did I sign up? Like, are there points on there? Like, did they put points on here and I didn't even know it? Have I paid out those points in a way that makes sense?
Yeah.
Jeez.
I think we had like one more. This one came up in another conversation recently too. What are trigger leads?
Sure. Yeah. So that's something that has just kind of come into popularity in the last, I'm going to say 2 to 3 years. So when you apply for a mortgage loan, the 3 national credit bureaus, we pull a credit report that shows all 3 credit bureaus' information on it.
Mm-hmm.
Right now, it is legal for those 3 national credit bureaus to sell your information, name, phone number, email address, to other lenders and say, hey, this person has applied for a mortgage loan.
That's
and
not
so
cool.
Then that lender who bought that lead will a lot of times call or email that person and go, hey, you just applied for a mortgage loan. Can we tell you about our mortgage program? And the crazy part is, to use an example, we had one example where one of our members recently applied, and within 5 to 10 minutes of us pulling their credit, they had 26 phone calls.
Oh
my gosh.
Yeah. The guy's phone was literally blowing up with all of these, and typically they're big national lenders, calling to go, hey, we know you just applied for a mortgage somewhere. Do you want to talk to us?
Wow.
And the guy was like, how do I make this stop?
Right,
I mean, his phone was just going nuts. He was like, what is going on?
Yeah.
So there is a bill in Congress right now to do away with that and not allow it anymore. Where it goes, who knows? Or stuff can, move like a snail through Congress sometimes. So don't know if and when that'll ever come to pass or not. But there, you can opt out of that. And the best thing to do would just be to Google it. There's a website you can go to that'll give you the option of putting in your information and then opting out of that. So the best thing that I can advise is if you think you're going to be buying or applying for a mortgage or refinancing soon, probably the first thing you want to do, if you don't want to get bombarded with those phone calls and emails, is just go opt out of that before you even apply anywhere. Because once somebody pulls your credit, then the process starts. And so once you're in there and have opted out, then you can go ahead and apply. And I don't think I can guarantee it, but you should not get hardly any of those phone calls or emails soliciting you for business.
Very good.
So, but yeah, it's become an issue in the last couple of years. 2, 3, 4 years ago, it was just kind of random here and there, but now we're hearing more and more stories about, similar to the one that I just told you, of people just getting bombarded.
Yeah.
Which is kind of crazy.
Well,
So,
and if we have that website, we can always put that in the description of this podcast for our listeners.
Yeah, I don't have it off the top of my head because it's kind of lengthy. I don't remember. I can't remember it right now. It's opt out something, but we can put it out there so people can find it. Otherwise, you could just Google it as well. So
awesome.
Yeah.
Well, we really like to end these episodes on kind of the theme of this whole podcast is kind of a penny or two for your thoughts, and getting what's most important that you want our listeners to take away from this episode. What's that one little nugget that they can take with them as they're looking at possibly getting a mortgage?
Yeah, sure. So I think it's selecting the right loan originator to work with you. And like I've said a couple of times already, understanding that the good ones will ask you a lot of questions and not just say, yep, here's your loan, sign here. Because as I mentioned, there's too many options and they don't know what options to give you if they don't ask you questions. So don't get offended if they're asking you questions. You're like, well, I'm applying for a mortgage. Why are you asking me about, college savings and what my retirement plans are? Because it all should factor into how we structure that mortgage loan for you. So by choosing the right originator, understanding the questions that originator is going to ask and then in working with them to make sure that they set you up. And then again, as I also mentioned, once the loan closes, you should be hearing from them once a year to see if there's anything that they can do to help change that depending on how your life changes. Yeah.
Very good.
That's great.
So yeah, pick a mortgage loan officer wisely. It's a relationship, not a transaction.
Right.
It's kind of the best way I can describe it.
Absolutely.
That's perfect.
Yeah.
Thank you so much, Brian, for sitting down, chatting with us, helping all our listeners kind of understand that mortgage lingo that we understand because we're in it day in, day out, but they may not be as familiar with, and helping them just be more prepared as they start their journey into a new home. So really appreciate you taking the time today to chat with us.
Yeah, absolutely. No problem.
Really just jumping in full on.
Yeah.
I mean, you had no idea what you're up for.
I mean, we all climbed this ladder to this high dive and I said, Brian, okay, we're going to jump right now.
You pushed real.
It was a nice little just tap. It was a
Here
tap.
you go. And bye.
Yep, bye.
Yeah. All right.
Bonus points for how big your splash is.
Yes.
All right, listeners, if you are still listening to this podcast, we appreciate you very much.
We do.
And if you have any additional financial topics that you want to learn more about, as you make your way through your life and all the financial things that you're uncovering, you can email us at apennyforyourthoughts@centrisfcu.org, and we'll track down the right subject matter expert to come onto the show and help answer those questions. And be sure to subscribe to our podcast if you don't want to miss an episode. We know you really don't want to miss an episode because it's you never know what you're going to get with us. And then help other listeners find us by rating, reviewing, and sharing. You can also follow Centris on Facebook, Instagram, Twitter, and LinkedIn, or you can check out our website at centrisfcu.org, where we have a lot of great financial insights. And if you just want to chat with one of our amazing experts, or you want to be synced up to one of our mortgage loan originators, you can give us a call at 402-334-7000. We really hope you enjoyed this episode. Thanks for diving in with us, and have a great day.
Thanks, everyone.